This is another episode of me putting my ass into these charts every single day until I discover a trade model that makes me millions and millions and millions of dollars. And in today's episode, I'm going to be doing the same thing that I did in the past two episodes, where I'm just reviewing observations that I made intraday, because right now I'm just studying price action, noting observations of hypothetical trade scenarios that I would have taken if I were in a demo environment or a live trading environment, tracking some metrics, and just going from there. So let's get a little update on today's observations. What do we have? Okay. So today I had two observations right and two observations wrong. And today there was a red folder event in the PM session, so I was able to get an observation in the PM session, and I ended up getting one wrong. But that gave me a huge insight into what I need to see to actually frame a trade setup. So I'm taking all these losses. I'm gaining so much market experience, and I'm not even having to put any money on the line, which is incredible. So this process is absolutely genius. Before you even go into demo trading, before you even consider live trading, do this. Record your observations of hypothetical trade scenarios that you would have taken, and if they are right and if they are wrong. And then these are all the metrics that I'm tracking. I tracked the time that I discovered it, how long it took to deliver to my objective or stop me out, the speed, how long did it take to move in my favor, how long did it take to move against me, and then distance, how many handles were delivered in my favor or against me. So tracking these metrics, recording these observations, and now I have a database, and I can build a baseline for my skill set, how good I am at reading price action, and I can develop an idea of what my trade model is going to be. So it's perfect. And I'm doing all this without even having to put any money on the line. It's fucking genius. And I'll say this again, this is something that I would never have done last summer, because last summer I came to the market every single day wanting to make money. Because I did that, I didn't make money. Pretty ironic, isn't it? You come to the market every single day wanting to make money, you're not going to make fucking money. If that's what you're focused on. You got to be focused on doing the right things and sticking to a process and adhering to rules and doing the right things. And I'm a year and a half into my trading journey, and I've finally realized that I've matured a lot. I've gotten a bit older, and just reaching a whole new level of maturity in my trading journey. So that's what's been going on recently. Like, never would I ever have imagined myself studying price action without even taking any trades, without pushing any buttons, right? Because you want to push buttons, you want to get in there, you want to make money. I'm not even doing any of that, but I'm getting so much experience from it. So it's awesome. It's a win-win situation. Okay. So I'm going to start with my first observation. I had four today. I watched the market run out relative equal lows. That's what I titled it, at 8:18. So yeah, this scenario, I actually watched a stop run take place live. So initially when I came into the market today, what I wanted to see, well, hold on, I got to go to the higher time frame first to explain this. I wanted to see price draw to this old high. That's my draw on liquidity. And we've been going up for a long time. So the bias is bullish. It's obvious that price is drawing to this old high. We also have this imbalance that's left unfilled. We took out this volume imbalance right here, and now I want to see price draw to this old high. So that was the draw on liquidity. But how, you have to develop a roadmap as to how the market is going to get there. And what I wanted to see occur, this is what I wrote down in my journal when I came to the market this morning. I was noticing all these highs right here were pretty jagged, but actually, if I think about it in hindsight, they really weren't. This is relatively equal to that, and this is relatively equal to that. And we come up just shy of this high, right? So that primes it. When the market comes up to this high, then turns away from it, that creates a sigh of relief for all the shorts off of this high, or anybody with the stop loss off this high. Retail is also going to pull up their charts and see, okay, we traded back to this high, and then we turned lower. That looks like resistance to me, and it just gets absolutely ran over. But initially what I wanted to see was price trade lower at the 9:30 open, see a Judas swing lower, a fake move, manipulation move lower to take out this smooth price action down here, and then come clean out these relatively equal highs up here. That's what I wanted to see, but that didn't happen. And that led me to take a wrong setup because I was stuck up on that idea later in the session, and I labeled that I got primed because I did. But let's go to my first observation. It was right here. So I'm going to hide this opening range gap. Not that. this. Okay, this is what I was watching at the moment. So, I mean, this was just clean, clear. Where's the market smooth? Where's it jagged? It's going to go there. Obviously, at the top of the 7 o'clock hour, the market shows a willingness to reject the new day opening gap. And this is the one from the previous session, so it's still hot. It's fresh. But look what we leave. Smooth highs, right? Okay. I read this. Bearish order flow throughout the entire 7 o'clock hour. No trades for me because starting at 7 o'clock, I'm looking and waiting for a smooth area in the market to form. And it happens right here. So that gives me the bias for the 8 o'clock hour. At the 8 o'clock hour, I want to see some kind of bullish reversal pattern to send price higher into these smooth highs. And that's exactly what I got. So originally, I was just studying the price action here, watching price respect the bearish order flow, watching it respect premium arrays and inverse discount arrays. But then I noticed this bullish reversal pattern when we couldn't inverse this imbalance down here. So we trade down into this imbalance and we just can't get past it. I mean, notice how the bodies of the candles stay inside of this imbalance the entire time. So that shows me that price is respecting it. Not only that, but for the most part, the bodies stay in the upper quadrant, which indicates strength. So initially we come down, we form this low, come off the low, and look at the body stay in the upper quadrant, right? So that indicates strength. Start to fade off of that. Trade into this imbalance, then trade back lower, refer back to the sell side liquidity under this low, run it, and I watched this happen in real time. What this candle initially was a large bold face down close candle that just stabbed right through this low. It went here and then it went boom and then doom, and I watched it happen in real time. So I was like, oh shit, did the algorithm just poke down there and reach into that sell side liquidity under this low? And yeah, it did. And this is all happening inside a buy side imbalance as well. And you notice the bodies of the candles stay inside the buy side imbalance. So I literally watched the market reach down in here and grab the sell stops under this low, which was pretty cool. Never saw that happen before. Well, I did see it the first time I studied price action, but now I actually understand, okay, this is what a stop run looks like. So that was cool. At one point, this was just a bold candle that went doom right into this low, and then we closed back inside the buy side imbalance. So still respecting it. And it wasn't until we had this large up close candle that I was like, oh shit, this looks like a long scenario, right? Because we have a stop run. We never disrespect this buy side imbalance down here. We have, what do we have? We have a change in the state of delivery right here. And look how the open price of this order block is respected once we violate it. So once we close over the open price of this consecutive series of down close candles, we see that the open price is respected. So that indicates a change in the state of delivery. So we have a run on sell side liquidity, a change in the state of delivery. So that tells me the market is now going to seek buy side above the marketplace. And it does so here and here. So this could have been a first partial right here. This is where I wanted to take my first hypothetical partial right here. We also have an imbalance to the left. So we respect the open price of the order block, and here's our breaker block right here, right? So we have a low, a high, a lower low, and a higher high breaker pattern. I thought this was a sell side imbalance. It is not. It's just a large wick. What else do we see? I think that's basically it, but that's really all I need to see. I just need to see a change in the state of delivery and a breaker block, and that's about it. And I need to see a run on liquidity. So checks not all of box. Oh, this was what it was. I forgot about this. I was looking for something else. I knew there was something else, but that's what it was. We have this volume imbalance, and notice how price stays in the upper quadrant, right? Literally ticks right down to consequent encroachment of the volume imbalance. So that is perfect. That is perfect. And then I see this large move, and this is what sparks my interest that the market may be reversing down here. Then we have this down close candle, and if you notice, price never trades back down to the consequent encroachment of this wick, and that indicates strength as well. So what indicates strength here? What tells me the market is going to reverse here? Well, number one, we see a discount array that fails, and by fails I don't mean it gets disrespected. I mean it never gets traded back to. The algorithm never refers back to it. So when I start seeing discount arrays fail, the algorithm doesn't even reprice back down to them. That tells me the market is strong and it's really in a hurry to run out the buy stops above these highs. That's what that indicates. So here's an indication of strength. Also notice how we work off of consequent encroachment of the buy side imbalance. Also notice how we work off consequent encroachment here and we stay in the upper quadrant. The bodies don't even close inside of this thing. It just wicks down into the upper quadrant. Never violates consequent encroachment. That's exactly what I want to see. Notice how we can't trade down to, or we do, but we wick off of it, right? We respect the consequent encroachment of the lowest discount wick. That is also a sign of strength. And then we all at the same time, we're respecting the open price of the order block. This is a very high probability setup. It's giving me all the green flags, exactly what I need to see. And if you think about it, this is also a breaker formation as well. So once we close over these little up close candles, the last up close candle before the turn lower, we open here and we trade back down into it, trade higher. And that's when we leave this volume imbalance that never gets reached down into, indicating strength. So that's perfect. That's everything I need to see. Okay, and the market leaves this little gap right here. Here we have an actual physical gap, so there's missing data there. Like how we wick just into the lower quadrant and then trade off that. Perfect. First target right here, smooth highs. Run it. Am I missing anything? I don't think so. Buy side imbalance, respected. Tap into the lower quadrant, but we see a nice reaction out of that. We don't spend any time at all in this buy side imbalance. And on all the setups I get wrong, I notice that price tends to hang around inside of imbalances and doesn't show any speed or distance or magnitude out of them. It just hangs around, meanders around, and then reverses. But we don't see that here. We see we trade down to the buy side imbalance. Once we run out these relative equal highs, we also tap into this volume imbalance and the sell side imbalance, and also this premium wick right here. But we don't spend any time here at all. It's aggressively seeking the liquidity above these highs, and that's where we see our reversal pattern to the downside. So, and you can also notice that it's leaving volume imbalances but never refers back to those as well, and buy side imbalances. So we have volume imbalances and buy side imbalances that never get referred back to. So the market is clearly strong. It is clearly wanting to take out the buy stops above the initial high formed in the 7 o'clock hour. So that was a clear, easy, long scenario for the 8 o'clock hour, and the bias was easy. And that played out for 28.5 handles. Risking, my hypothetical stop probably would have been, I think I like to use mean threshold of the order block or consequent encroachment of a wick. So it would be here or here. But this is just best case scenario in the hindsight. In the moment, actually live trading this, I don't know if my stop would have been this tight, but I don't know. Maybe I should be more realistic and think I would probably freak the fuck out in a live trading scenario. Actually, why would I say that about myself? I wouldn't. I would be calm and take deep breaths and all that and journal it. So let's say hypothetically 4 handles of risk making 28.5. So yeah, decent setup. Remove all this. And then my second observation came at 9:12 in the morning. So, narrative behind this trade, from what I came to the market initially expecting, I wanted to see a run on these lows. And before the 9:30 open, which was where? Right here? Oh, I deleted it. No, I didn't. Yeah, I didn't. 9:30, right there. So before the 9:30 open, predominantly most of the money's been made on the long side of the market. So at the 9:30 open, I want to see this thing drop lower, take out profitable longs, and then trade higher. But I wanted to see the market run out these smooth lows. It never got down there though, but it did run out the first most clean, clear, obvious low, where if you were long from the London session, you probably would have trailed your stop loss here, right? If we break out from this high, you probably would have trailed your stop loss here. And so we do initially trade lower at the 9:30 open and wipe out the trailed stops underneath this low. We also refer back to this buy side imbalance. So that's an area of interest. That's what I wanted to, well, I wanted to see it come down here. Never quite got down there, but there's still opportunity to capitalize on that little down move, which I barely squeezed anything out of this hypothetically. And if I'm being real with myself, I probably would have set a farther target that would not have gotten hit. So we can see that the 8 o'clock low forms this relative equal low right here. And that is the terminus of this move. And we can also see this buy side imbalance here that it reaches down into. Doesn't get to this low, but we have this imbalance here that it trades down into. So that. This is what I saw before the 9:30 open. So I see this reversal. We run on relative equal highs. I begin to see some meaningful displacement to the downside. The market starts to look a bit bearish. I have this sell side imbalance here. And when I see this reaction off of the new day opening gap high, when I see this pattern right here, this is a breaker formation because we have a high, low, a higher high, and a lower low here. Now that I'm looking at this in hindsight, we never made that lower low. So there wasn't a breaker formation. But I guess you could say high. And we don't even have a market structure shift. How did I not realize this in real time? Okay. So, honestly, I didn't have any faith in this trade at all. When I saw the market come back and do this, and ahead of the 9:30 opening, it created this large wick, and I didn't have any faith in that at all either. But looking at this in hindsight, this isn't a trade setup at all that I should take. So, learning from this right now in real time as I'm reviewing it. But I saw this big down close candle leave an imbalance, and I was like, oh look, we have a high, low, a higher high, and a lower low, but it never made that lower low. So is it a breaker? No. I was like, oh shit, it's a breaker. It's not a breaker. But we were showing willingness to react off of the new day opening gap high. We're trading into the high of it, right? And then we see this large displacement, large down close candle. So I got a hypothetical short entry here, and I anticipated this to be the breaker block, right? But I never even saw a market structure shift with meaningful displacement. So really, I got lucky, and hypothetically, I saw this as well. Inverse fair value gap. Saw that as well. So I had inverse fair value gap. I thought, okay, this is a potential trade scenario. So I'm still working on what my model is. I don't think it has to be a breaker formation, but what I'd like to see is a breaker formation with an inverse fair value gap and a fair value gap. In this case, we have both, but we don't necessarily have that breaker formation. But there is a scenario that I watched in real time later in the session where there was no breaker formation because the move was so elongated that it wasn't allowed to form the breaker formation. But here, well, what I'm trying to get at is I think if I see an inverse fair value gap and a fair value gap aligned, as well as a change in the state of delivery, that is a trade idea. So here's a change in the state of delivery, right? We close over the series of up close candles. You have a little stop run right here. You could say that we trade into these smooth highs. Not the cleanest setup, but framing that around the narrative that I wanted to see 9:30 trade lower, which initially it did, which was in a manipulation move, and take out these lows down here. Never got down there. See, I put a little target there. Never got down there. But it did take out these lows and wiped out trail longs, if you trailed your long, or if there were some trail longs down there. Probably were. There's always liquidity resting under lows. But what gave me confidence at the 9:30 open that this was probably going to work out we form this discount wick, and then on the consecutive candle, the following candle, we disrespect the consequent encroachment of that discount wick. So that tells me price has the ability to trade lower, not respecting this wick. We could probably visit this low down here. And then we also have this premium wick that we never see consequent encroachment get violated. So that gives me the confidence the market's going to trade down into these lows down here, and it does. But it doesn't deliver to where I thought it would go, which it doesn't have to. I still hypothetically take partials on this trade. But if I was using the logic from earlier and I would have my stop loss at the mean threshold of the order block, I stop out. Or even if I have it above the inverse fair value gap, I stop out. The only way that I wouldn't stop out of this trade is if I place it above this high. So what I'm coming to realize is that my stop loss is probably going to be 20 handles of risk max. And I can tolerate a stop loss above this high because it's only 6.5 handles, which is nothing, and I would be targeting. First, I would target this low and then this low terminus. So what is the risk to reward on that? Let's just say there. This is all hypothetical. 4R, okay? So that was that setup. Kind of iffy, not the best, not the cleanest, not the one that I'm most proud of. And then I have this observation right here. So at this point, what I saw at the 9:30 opening was initially we trade lower, we stab into these lows, and then we begin to fade higher. So at this point, I'm thinking, is this the start of a directional move? Is this where price is going for the day? And I'm looking to see, do I have a long scenario? If I were to take a long down here, do I have a long scenario below the 9:30 opening? Thinking in terms of daily power of 3, which I tried to hunt one, and I don't really have one. Everything is kind of overlapping. I don't see any gaps, except maybe right here, market structure shift. We see a change in the state of delivery. We never violate this order block right here. The down close candles that led to that stop run. So that's a high probability order block. But I didn't really see anything that I would consider a long scenario in here, which is just something that I have to train my eyes to get used to, because I'm a novice in the beginning stages of my development. So not too worried about that. And this is where I kind of got confused when I saw this large drop, because I mean, at this point, I was still stuck up on the idea that I wanted to see price come and take out these equal lows left in the London session, but never got down there. So I was just confused as shit. And at this point, what I saw on ES at the same time was an SMT at the lows. So I know that this clear cracking correlation is going to send price higher, right? At the 9:30, and it's at a specific element of time as well, at the 9:30 open. Wait. Oh, relative to this low right here, right? We get an SMT. So that's the first SMT that I see, and I think, okay, this could potentially send price higher. And I'm reading the order flow on a higher time frame, and it's bullish. Every down close candle is supporting price. We don't see the opening price of open or up close candles violated. We're respecting discount arrays. And I also have that SMT at the low, so at this point the narrative was clearly bullish. But then I see, not that. Yo, what? Okay, right here. But then I see this, which is my ideal sell scenario, where I have a low high, a high, a low, a higher high, and a lower low with this large meaningful displacement. I have a change in the state of delivery. I have a large sell side imbalance. I have no inverse fair value gap. I have a breaker block though. So I was seeing, once I saw this meaningful displacement, I was looking to see if price could come refer back to the open price of the order block. And then do we come trade lower, run out these relative equal lows? I mean, this was on my mind the entire session. I got stuck up on the idea that price was going to go down there. And so that made me attempt this short right here with the stop loss probably above the swing high, 20 handles of risk. to make potentially, this would probably be a partial, another partial, and then terminus down here. But what really happened after the fact, this is what I realized, this is what price did. We traded up near this high. We turned around and fell short of that high. So what does that do? Well, for retail traders, what that does is make it seem like this general area of price is a strong area of resistance. Here's that candle that I got short on. And if we look, retail is probably looking at this and thinking every time we come into this supply zone, we have a strong reaction out of it. This is a strong area of supply. This is tough resistance. So if price comes back into this area and we see a strong drop out of it, let's go short. And where are they going to place their stop loss? They're going to place it above this high. So this move, when it comes just right up near those previous highs and then turns lower, that is priming this high. That is engineering more buy-side liquidity. And so I got primed because this is what was going on, although I was unaware of it. And I just saw my breaker formation and wanted to get short because I kept holding on to the idea that price is going to come trade down to these London lows, which was not the case at the time. And then this explosion just came through and just wiped me out. Where is my opening range gap? And at the time, this is something I had to work on. At the time, I didn't have my opening range gap on the chart. So, quick little lesson that I learned from there is that I need to be mindful of my important levels that the algorithm is going to refer back to. Because if you look, price is wicking off of, what the fuck? Whoops. Price is wicking off of the high of the opening range gap. That is a very important area, and it does it again here. So that probably tells me that the trade idea is invalid here, especially once I see this explosion in price. And the entire time, I also knew my draw on liquidity was higher, and I was fading that move because I wanted to see these lows taken out. So I hung on to that idea, and I was just looking for anything to potentially take the market down there, and this was kind of it at the time. But it didn't play out, obviously. I would have stopped out on this trade, so I got this one wrong. So I was trading against higher time frame order flow. There was an SMT at 9:30. That was a clear indication that the market wants higher prices. The draw liquidity is higher, and I got primed. So a big takeaway from today is that in order for me to take a setup, I need to see price engage some level of liquidity. If it doesn't do it, not a setup. And well, I guess that doesn't apply here because we have these relative equal highs and it runs it because it's a breaker formation, which is why I want to look for a breaker formation because a breaker formation has a run on liquidity. So I think here I was just fading the current narrative in play. Even though I knew that this thing wants to draw higher, I still tried to short it, which doesn't make sense. So. And then I have this afternoon setup that I also got wrong. So I counted this as wrong, although I corrected myself on the narrative in play and then actually ended up catching my draw on liquidity was correct. But where I initially looked to get into the trade and position in, knowing that bias, I was incorrect. So let me redo this. So, ahead of the red folder event at 2 p.m., we had FOMC minutes at 2 o'clock. I'm thinking, what is the narrative? What has the market done? Where could it potentially reach to? So I go to my higher time frame and I look. Well, we actually ended up delivering to the London lows as I anticipated. We made this area price jagged. This is a significant run on liquidity. We took out those smooth London lows. So we have Asia low and London low swept, right? So major liquidity removed from the marketplace. Everybody's profitable on this run, wiped out. They're stopped out. So I'm looking at that and thinking, okay, what's the current narrative in play? Knowing that information, well, actually that has nothing to do with it, with the setup that I took because I was shorting the market still. Well, I don't know. This really doesn't have anything to do with the setup that I took. Basically, all I'm doing is thinking, where's the market smooth? Because that's where stops are going to be. And it's right here, inside of a new day opening gap. So this draw on liquidity is supercharged because not only do we have a new day opening gap, but we also have relatively equal lows. So I know that the market is going to go down here. And what does it do? It goes down here. Not only that, we have an opening range gap below it. So that is supercharged, I guess you could say. And so at the 2 o'clock, red folder, we trade higher, then immediately displace lower. So I'm thinking, okay, where's the market trading back into? And I look on my chart and I see this. This is what I see. So I'm seeing price reject the 5-minute sell side imbalance and also the mean threshold of this order block. So I'm looking at it and thinking, okay, I might have a trade idea here. And the same setup that I took earlier, that I don't really know what it was. What I see here is a inverse fair value gap and a fair value gap. Those two overlapping, and that gives me a potential trade idea. So I was anticipating that the market was rejecting this higher time frame PDA raise, and then we see a return into this sell side imbalance and then trade lower, clean out these lows. But that did not happen because I had to wait for some sort of run on liquidity. If you notice, that was the only thing missing here, referring back to a sell side imbalance, but I don't see a run on buy side liquidity. And so that is a key element to my trade setup. I know that for a fact, even though I don't have a good idea of what my trade model is at this point. I know that that is definitely a part of it. So we inverse this, sell side imbalance, trade back into it, and now I'm thinking we're coming down here. So this is my target the entire time. I'm thinking down here. And do we deliver? Yes, we deliver. Fuck. But why did this trade setup not work? I'm gonna mark this. So we can see that when the market refers back to the inverse fair value gap, we come up and we tap consequent encroachment 1 time, 2 time, begin to fade lower, but there's no follow through there. And we just come right back into the range, and then we just meander around. We trade sideways, picket fence action. Every range is overlapping the previous range, and look how many times we refer back to this inverse fair value gap, but there's no move off of that. That is not what I want to see at all. I want to see this thing refer back to consequent encroachment or stay in the lower quadrant and then see speed, magnitude, and distance off of that lower attacking these lows, and we don't get that. So that tells me the market is still in the buy program. There is no change in the state of delivery to allow the market to begin seeking the sell side liquidity under these lows. It still wants to seek buy side liquidity, which is why we don't see a breakdown until we have a run on buy side liquidity. Then we get the change in the state of delivery. Then it attacks all these smooth lows and all these smooth lows. But right here, we don't see a run on liquidity. We don't see the market attack buy side. So there's no change in the state of delivery. This is kind of meaningless in my eyes. I would like to see something more significant like this. Boom. Boom. Change in the state of delivery. Boom. Sell it here. I mean, you don't even have to get short on this institutional order flow entry trail right here. You can get short on the open price of this order block with this imbalance with a inverse fair value gap. So multiple things coming together right here. But I knew this trade was not likely to pan out because of how it just slowly grinded higher. So I knew it was not yet ready to attack these lows. Because if it was, we would have seen it trade to consequent encroachment and then dive lower from there. But it didn't do that. It just hung around, chopped around, moved sideways. And then it went for the buy stops above its high. So that's how I know that this did not play out. And it wasn't until I saw this and I saw, boom, huge down close candle. like 40 handle candle. Inverse fair value gap. Volume imbalance, left untouched. Volume imbalance, left untouched. Institutional order flow entry deal, kinda. Up close candle, violated. Extend out the open price in time. Trade up into it. Don't necessarily reject it, but look at this. Boom. That is perfect. Nick, 4, 9, 16 and a half. Right there. That is fucking perfect. You can't get better than that. So the mean threshold of the order block is at 16,916 and a half, and this is where this candle stops, and we never look back from there. So that's a clear indication that, yeah, this thing is weak. Not only that, but this fails, this fails, this stays in the lower quadrant, just reaches into the lower quadrant of the sell side imbalance, and then boom, this is what we see after. So at this point, I know the market is in a low resistance liquidity run. It's going to absolutely eat these lows, and it does. How we respected this sell side imbalance. So we traded into the upper quadrant here, but faded back lower underneath it. Trade back up into it one more time. Touch consequent encroachment. Work off of it. Large down close candle. Premium wick. Taps the open price of the order block. Trades lower. Sell side imbalance. Volume imbalance. Failed. Consequent encroachment of this discount wick. Violated and inverse. Does the market react off of that? Kinda. This is inversed. Once this is inversed, wick up into it. It's permissible to color outside the lines because it's just referring back to this order block right here. Premium wick. Do not reach consequent encroachment. What does that indicate? Weakness. Large range candle. Reject order block. Reject IFVG. Large range candle. Sell side imbalance. Fails. Sell side imbalance. Trades up into lower half of the quadrant, or the lower quadrant, and immediately rejects it. Here's a wick. Kind of color outside the lines a bit. Do I see any immediate rebalance? I think this would also be an immediate rebalance, wouldn't it? Because we have this large range candle. We trade right back up to this candle's low, which is also an order block. So I think this is an immediate rebalance. I mean, everything just suggests that price is very, very heavy. And I know that we are going to absolutely destroy these lows because look what we do here. This is what caught me off sides on the short side of the market earlier. We come trade down to this low, and then we turn away from it. So what does that get retail thinking? This is support. No, it's not. No, it's not. I was even writing in my journal at the time that, what did I say? This area is a strong area of support, and then look what happens. It gets destroyed. Liquidity taken. Liquidity here taken. So when price comes just shy of this low and turns away, people are thinking, oh, it's coming back down to support and it's moving off of it. Let me get long. You got fucked. So I used to trade like that and it doesn't work, which is crazy because now I'm doing the opposite, literally the exact opposite value I used to trade, which is awesome in my opinion. We trade all the way back down to the lower quadrant of the new day opening gap. Consequent encroachment. respected. Trade higher. Attack these smooth highs. Last hour macro from 345 to 4. Refers back to these. Here's the last hour macro here from 315 to 345, and this is what we do. And that's basically it. So those are all my observations today. Learned a lot. Still learning what my trade model even is. Don't really know what it is. I know that I like to see a breaker formation, a fair value gap, an inverse fair value gap, a change in the state of delivery, an order block, a breaker block, of course. But I also like to see just an inverse fair value gap and a fair value gap together. And that in itself, I think, is pretty powerful. So still getting an idea of what it is that I look for. And that's it for this episode. I'm going to come back and do the same damn thing tomorrow, because I'm going to do this every single day until I do find a system that makes me millions and millions of dollars. Why does my camera look so good when I'm this close? But over here it's shit. Is that because of lighting? Huh. Interesting. Alright, that's it for this video. Goodbye.